Hi everyone! Optimism on Wall Street improved following the release of the Fed meeting minutes. Today, US and Asian stocks are extending gains. However, trading was lackadaisical in the morning as the US celebrates Thanksgiving Day. Apart from that, growth is also limited by uncertainty of the coronavirus situation in China. According to the minutes, the majority of Fed policymakers stated that it would be appropriate to move to a slower pace of rate hikes. It may help the regulator better assess the results of monetary tightening. However, Fed members are also uncertain how much time it will take before inflation starts declining. Following the last meeting, Jerome Powell stressed that the Fed is nowhere near declaring victory over high inflation. All other policymakers have been making hawkish remarks for several weeks after the meeting. They pointed out that more rate hikes are needed to tame inflation. After that meeting, investors digested lots of economic reports which somewhat convinced them about a 50 basis point rate hike in December. A contraction in the PMI indices for the fifth month in a row also suggests the likelihood of smaller rate hikes. The manufacturing PMI index fell below 50 for the first time since 2020. However, consumer spending and the labor market have remained resilient so far. It helped the US to avoid a recession. The Fed was able to stay committed to aggressive tightening. Investors are closely following fresh economic and inflation data, looking for any signs that the Fed could switch to a softer stance. Judging by the FEDWATCH tool, they are now betting on such scenario. Currently, 75.8% of traders are anticipating a 50 basis point rate hike in December. The US dollar dropped sharply across the board, especially versus the euro and the yen, amid expectations of a smaller rate hike. After declining below the support level of 106, it may soon test the 3-month low of 105.34. This scenario looks likely if risk appetite persists. Having lost 5.1% in November, the US dollar is likely to notch its worst monthly performance in 12 years. In the Asian session, the US dollar index dipped to 105.95, moving towards the lower border of the range 105.6-106.1. However, analysts warn that investors are overly optimistic about the potential change of the Fed's stance in December, and the sell-off will hardly last for a long time. Inflation in the US is soaring. The Fed is still unable to push it to its 2% target. In addition, demand for the US dollar remains high amid the zero-COVID policy in China. The greenback could have lost momentum because of the latest inflation data, which turned out to be below forecasts and undermined the rally of US Treasuries. Naturally, the yen took advantage of the situation, climbing against the greenback for the third day in a row. In the morning, the dollar-yen pair managed to touch its weekly low near the 138.80 level. The bears tried to push it to the support level 138.4. In the Asian session, the pair was mainly declining in the price corridor of 138.6-139.7. Although the yen has already approached the uptrend line of 138.9, there are plenty of factors that may limit its further rise. The outlook for the pair remains bearish. The Australian dollar is now trying to break through the pivot level of 0.6800. Its bullish momentum is subdued because of falling demand for commodities and concerns about stricter lockdowns in China. However, it won luster with investors thanks to increased risk appetite and optimism in the stock market. The Australian-American dollar pair was trading at 0.6745 in the Asian session amid the weakening of the greenback. Today, it extended its two-day winning streak, moving steadily in the upward range of 0.6726-0.6770. That is all for now. Trading floors in the US are closed today on the occasion of Thanksgiving Day. This is why trading volumes are likely to be significantly lower. Hit the subscribe button and stay up to date with the latest market news. See you!